Thank you. I'm glad to be here. So I am going to try to share my screen if that's okay with you, because I do have a deck. So let me see if I can get this to work. Can you see that?
Yep, we can see it. And I wanted to remind people that there's a Q&A section at the bottom where you can type questions in for Olga to answer them at the end of the session. But yeah, I can see your screen.
Okay, great. So thank you very much for having me. I know we have an hour together, and I was in light of all the recent changes with TCJA 2 years ago and the CARES Act that was just passed back in March. I thought it would be prudent to go through some of the recent changes that we've seen and walk through some of the impacts to your members and various businesses in the industry. So what we're going to cover today is the tax landscape pre-COVID, as well as the tax landscape post-COVID, some planning opportunities for businesses, some succession planning opportunities, and then hopefully some time for some Q&A. And I'm happy to answer questions as they come up, although I may need to hear someone that there's a question because I am viewing it in full screen. So happy to answer as questions come up. So our tax landscape pre-COVID. For corporations, the tax rate, as many of you know, was reduced to 21%. There was a suspension of AMT tax. They did eliminate net operating loss carryback rules and imposed an 80% limitation on those NOLs. We've also seen some business interest limitations, and specifically that is limited to 30% of what's called ATI. And the reason for some of the additional information is that those provisions have subsequently changed with the CARES Act, so I thought it would be relevant to address that with this group. So 30% of ATI is in essence 30% of EBITDA plus any interest income. Bonus depreciation was increased to 100%. However, there was a codification issue with leasehold improvements that were outside the scope of the bonus depreciation rules. And then Section 179 limit increased from $1 million and the phase out was increased to $2 million. For pass-through incomes, they introduced a provision called 199 Cap A, which allowed for a deduction for certain businesses that were treated as pass-through, which somehow was supposed to rectify the disparity in the tax rates between individuals and corporations. They also imposed a business loss limitation, which was $250,000 for single individuals and $500 for married filing joint. There's also some rules with respect to specified service trader businesses, and I don't want to get into the weeds with all of that and make it such a tax technical discussion, but the losses are limited. They don't get lost. They do get built into your NOL on a go-forward basis, but the current year was limited to either $250 or $500. The same elimination rules for NOLs applied, and the imposition of the 80% limitation also applied. The same interest expense limitation as exists for corporations, affectionately called as 163J. Same rules with depreciation expense and 179. And then some of the individual income tax changes that we saw was also an overall rate reduction where the max rate decreased to 35%. And as many of us know, there were a number of Schedule A itemized deduction changes. So the government did increase the standard deduction to $24,000 for married filing joint and $12,000 for single individuals, but they capped on the itemized side the state income tax deduction, which also would include real estate taxes and any other state and local taxes, to $10,000 per tax return. So that's not per individual, it's per return. They also suspended the 2% itemized deductions, as well as the casualty loss provisions, unless it's a federally declared disaster. And this is important because it will come up later on in our presentation with respect to some tax planning ideas for people who have suffered a loss in the post-COVID environment. Charitable contribution limitations were increased to 60% of AGI, and elimination of carryback rules, and the provisions do sunset for individual taxpayers in 2025. And I just wanted to set the stage with some of that background so that as we talk about the changes that were passed with the CARES Act, everyone has a bit of a frame of reference. Certainly there were a lot more changes to the tax landscape as a result of TCJA, but these are the ones that are most relevant for our discussion today and some of the changes that came through with the CARES Act. Last but not least, on the estate tax side, we had a significant increase in the estate tax exemption amount, which in essence doubled, and I am using round numbers here. They are not exact. They do get adjusted for inflation every year now, which is contrary to what it was like before, where the number was stagnant until there was legislative change. But the exemption in essence doubled and went from $5.5 million to roughly $11 million, again with an increase annually due to inflation. What's important about this, again, is it will come up a little bit later in our discussion with respect to some planning tools on what business owners can do to take advantage of this increased unified credit amount. Again, this is also set to sunset 7 years from the enactment of TCJA, which was required for it to meet budgetary, to be budgetary neutral. So having said that, why don't we go through some of the changes in post-COVID and some of the things that have been enacted as of March in order to help businesses save on cash flow and really get their businesses refocused from a cash flow perspective as well as an income tax perspective. So some of the changes that we've seen in corporations, they enacted the 5-year carryback rules, again, which were previously eliminated with TCJA. And they also eliminated the 80% limitation, where now 100% of taxable income is able to be offset through the year 2020. The TCJA rules will then go back into effect as of 1/1/21, which basically state the 80% limit on NOLs and an unlimited carry forward amount. So why is this really important? Well, certainly cash flow is important to businesses today. And in most of the clients that I work with, they have been really cash conscious and trying to come up with efforts on creating pockets of cash without necessarily borrowing. And if the company that is a C corporation had some taxable income in prior years, now can take advantage of this 5-year carryback provision. What's also great that the government did is that they extended the filing period for Form 4466, which is known as a quickie refund, and businesses can file using that mechanism by July 15th. the IRS typically will issue the refund at a much faster rate than filing through an amended tax return methodology. However, as you can imagine, many businesses have started utilizing this benefit, and now from what I understand, the IRS is a little bit backed up in processing the claims. However, it is still a much more efficient and practical way to file for a carryback claim and request a refund than it is to amend the tax return. Another item that was changed, as we discussed with TCJA, this introduction of business interest expense limitation, and the fact that it was limited to 30% of ATI or EBITDA plus interest income. Well, now that expense limitation has been increased from 30% to 50%, and that would apply for tax years 2019 and 2020. As an aside, I'm certain that most of the participants on this call are looking forward to the extended July 15th deadline, which we're a few weeks out of. So corporations really, if they have not filed their return yet, their due date is July 15th, along with us individuals. So this would be a great mechanism for businesses to take advantage and potentially deduct additional interest expense that they would otherwise not have been able to deduct before. Additionally, what was very good that the government introduced is that for tax years 2020, which you know, some of our clients and businesses across the country have clearly not been doing as well in the tax year 2020 as they were in 2019. And let's just say hypothetically in 2020, their income was, you know, only $10,000 compared to $100,000 in 2019. Well, what the government has allowed us to do is, in order to compute this computation for 2020, they're allowing the taxpayer to make the limitation based on the 2019 year or 2019 ATI instead of 2020, which would allow the taxpayer for an additional deduction in 2020 that it otherwise may not have been allowed. Now, the rules are going to be a little bit different for pass-through entities, and I will cover that, but this is a really good piece of legislation for our corporate clients. The other thing that they did was issued a technical correction to the bonus depreciation on leasehold improvements, which is what I mentioned under TCJA. Most, if not all, the accounting firms I know of agreed that there was really no mechanism to take bonus on qualified leaseholds that were placed in service in 2018 and thereafter. So as part of this legislation, this was technically corrected, and that now allows taxpayers to go back and correct the 2018 depreciation records that they previously had reported had they had qualified leaseholds. Now, again, why is that important? Well, before, you would have had to depreciate those leasehold improvements over 15 years since they were not eligible for bonus. Now that they are bonus eligible, you have two choices on how to really correct that. You can either go back and amend your 2018 tax return, and if you're a corporation, that may or may not create less taxable income, provide additional deductions for the 2018 year, or you can file what's called a Form 3115, which is an accounting method change form. And in this case, the 3115 would be considered one of the automatic consent 3115. So there's a concept called automatic and non-automatic. Automatic means you don't need the IRS consent. Non-automatic means you do for any kind of accounting method change. In this case, it's an automatic change. So if you want to take advantage of the bonus depreciation on assets that were placed in service in 2018 and you don't want to go back and amend, you can file Form 3115 with your 2019 return, report the additional bonus depreciation on your 2019 return. There's some computations and schedules that would need to be attached to the 3115, but in essence, you'd be getting 100% of that bonus depreciation for any assets placed in service in 18 on the 19 return, less the depreciation previously taken on the 18 return. So again, what's beneficial here is that if you had substantial leasehold improvements, you can deduct that in 19, and then you can also look to the NOL rules to see if there was an NOL created, and then you can follow through and see if you have an opportunity to bring back any of those net operating losses to prior years utilizing the 5-year carryback claim. And again, from a timing perspective, if you are looking to do the quickie refund, you may want to finish your 2019 return early enough that you can do the return and then also do the quickie refund claim by filing the Form 4466. So for pass-through entities, as I said, the business interest expense limitation is a little bit different than it is for corporations. The ATI limit still stays the same for 2019, which is still at 30%. However, if there's this excess interest expense, and I'll go into that in a second, and that information is stated on the K-1, the partners themselves are permitted to treat 50% of their allocable expense as paid or incurred. So let me just explain that a little bit more. What happens at the partnership level is that while the entity itself has the limitation to 30%, it can offset its taxable income by that amount. And then if there's interest left over, let's say they actually had another 10% that was in essence non-deductible, you would see that as a footnote on the partner's K-1. And the partner then would be tracking that excess business interest expense that it was not able to deduct separately on their individual tax return until such time that the business actually has sufficient income to utilize that interest expense. Well, here what the government is saying is that if there is this concept of excess business interest expense, the government will allow the partner to actually deduct up to 50%. So in essence, you're getting to the same number, you're just getting to it at the individual level rather than at the partnership level. For 2020, that number does increase to 50%. And same as corporations, you can also elect to compute the 50% limit in 2020 based on 2019 ATI. Same change with respect to the technical correction of bonus depreciation and leasehold improvements. And the same thing applies with respect to procedurally, do you want to go back and amend 2018, or do you want to include a 3115 in your 2019 tax return? Now here, the considerations are going to be a little bit different. Here, you'd really want to look at the partner's income. And let's say we have a family-owned business where you are fully aware of what the individual income tax situation is. Let's say the 2018 tax year was very strong and the taxpayers did pay significant income tax with 2018 filings. But let's say outside of the leasehold improvements, 2019 is not as much of a substantial year. Based on the rate implications and what bracket you're in, you may want to then file the amended return. Let's say you were at the 35% rate, but in 2019, you might be in the 25% rate. So from a rate perspective, you may want to get back some of those tax dollars that you had previously paid, rather than including the deductions on 19 where you'd be taxed at a lower bracket. My advice to clients here is that it's really more beneficial to run a projection to see where you're going to get the most bang for your deduction. So I would highly encourage the participants on this call to do that and really talk to your tax person and run the projection to see where you would receive the most benefit. Some of the other things that the CARES Act provided for are retention credits, employee retention credits, as well as payroll tax deferrals. And again, this is something that you'd really want to discuss with your tax professional to see which one is more beneficial and what is more beneficial to your business. Is it an either or? Is it a both? You know, there's different start dates, as you can see by this slide. From a credit perspective, you're starting with March 13th. For the payroll tax deferral, you're starting with March 27th. Additionally, the payroll tax deferral, many businesses clearly don't run their own payroll. And in discussions with some of the payroll companies, you know, they rely on the business owners to really communicate that whether they want to participate in the payroll tax deferral program. So on this slide, you will see some of the qualifications. If you have 100 or fewer employees, there's really no restriction for the employer retention credit. If you have more than 100 employees, there's a restriction with the kind of business you can operate. So you're unable to provide services. For the payroll tax deferral, I really can't, I wouldn't understand why any business who had some cash flow issues and was really looking to monitor their cash flow wouldn't utilize this. This is a deferral over a 2-year, in effect, it's really kind of almost like a 2.5-year deferral on the employer payroll portion that would be required to be remitted to the IRS. And again, you'd be working with your payroll company to opt into this opportunity. This is not a deferral for the employee portion where the employer acts as a fiduciary to hold the withheld monies, only the employer piece. And you're looking at the period of 3/27 through 12/31/20, and really the 50% isn't even due until December 31st of 2021, and the other 50% is due on December 31st, 2022. So there's a significant deferral opportunity, which is interest-free, penalty-free for businesses to help them preserve cash. The other thing that's really important to note is that this is also available to self-employed individuals for the employer portion of payroll taxes. So again, just something to think about from a cash flow perspective that you may want to discuss with your payroll company as well as your accountant to see if you can utilize these two benefits. And I would be remiss if I didn't spend some time talking about the loan programs that have come out of the CARES Act, which I know there's been an awful lot in the media, all over the websites, but I do want to spend a little bit of time talking about these loans, particularly the PPP, which has had a lot of positive feedback. You know, it's been a little bit of a challenge because the program itself continues to evolve, as I will note in a little bit more detail, because the SBA continues to publish additional frequently asked questions and provide additional information to businesses that have taken the loan. So it's an ever-evolving landscape, but as it continues to evolve, it really does continue to be business-friendly. So for example, when it was first enacted, the measurement dates were fixed, the repayment period was stated, And then that was extended to 26 weeks from the original time marker. The Payroll Protection Program was really designed for employers to be able to keep their employee headcount, continue to pay their employees while revenues were not coming in. And if the items were repaid within a specific period of time, there's potential 100% loan forgiveness for the taxpayer. So overall, very, very friendly. The economic injury disaster loans are also loans that were available through the SBA. And then of course, many state and local governments came out with their own small business assistance programs. Like in the city of Philadelphia, I think they had clearly far more applicants than they had monies to hand out, but all majority of jurisdictions, states and local governments did have some sort of program that was available to local businesses. So for individual income taxes, similar to corporations, we have the enactment of the 5-year carryback rules. Same rules apply. So if you have a business that is a flow-through entity that was generating some losses, now you can go back and carry back those losses to prior years. Again, similar to corporations, you've got 100% offset of taxable income through tax year 2020, whereas before it was limited to 80%. And then TCJA rules kick in at the same time as for corporations, which is 1/1/21. We all saw in the media the advanced rebate payments that were being issued for those taxpayers who did not receive the actual rebate. That will be an allowable credit on their tax return. Some of you may recall during the Bush administration, we had that $600 advanced credit as well. So this is a very similar concept to what happened back then. This is the next piece is pretty critical for flow-through businesses. So I had discussed the business loss limitation that was capped at $250,000 or $500,000 for married filing joint. Well, that was suspended as part of the CARES Act for tax years 2018, 2019, and 2020. So again, there's some tax planning opportunities here where you'd want to evaluate if any of your losses from the tax year 2018, which were not lost but got billed into your net operating loss for 2019, whether it's more beneficial to go back and amend the tax year 2018 return or leave it alone and leave it as part of the NOL for 2019. So I would encourage the participants to really look at their tax returns, tax brackets, to see what would yield the most cash flow from the suspension of this rule. The other interesting piece is that you always hear about don't ever withdraw out of your 401k. There's a 10% penalty for early withdrawal. It was nice to see the government put this waiver of the penalty in place for taxpayers who were affected by COVID. The documentation is fairly broad with respect to what is affected by COVID mean, and really you get not just the waiver on the 10% penalty, and while there is a $100,000 limit for the distribution, you do have an opportunity to put that money back into your 401k should you decide you need it this year for cash flow purposes. There's a 3-year repayment period that's available. Additionally, if you choose not to repay it, but actually take the distribution, your inclusion is ratable into taxable income over 3 years, meaning you're not going to pay tax on 100% of the distribution or the 100,000 on your 2020 return. You'll actually be able to spread that over a 3-year period and pay tax on $33,333 a year for 3 years. So there's a lot of option there. Additionally, they provided for loans that are available to be taken from qualified plans. For those taxpayers who have to take required minimum distributions, given the stock market volatility, those the required minimum distribution amounts were waived for 2020. In order to incentivize charitable contributions, they did create an above the line charitable contribution, which wouldn't be subject to Schedule A limitations. So let's say you were not able to itemize on your tax return, you would still be able to take a $300 charitable contribution on, in essence, page 1 of your return to get you to adjusted gross income, rather than putting all of it or 100% of it on Schedule A. The other incentive is for those taxpayers who are able to itemize. The AGI limit of 60% was waived. So in essence, you can get 100% deduction against, or itemized deduction against your AGI if you chose to make significant donations in tax year 2020. Now, it does say for qualified contributions, that is defined in the Act, but it's typically 501c3 organizations. So now that we've laid through some of that groundwork with respect to TCJA and the legislative changes that have occurred with the CARES Act, what are some tax planning opportunities that you can all walk away with here to have subsequent discussions with your teams to see, okay, how can I either drive my tax liability down for 2019 or some tax planning opportunities that may not otherwise have been available. So certainly the big one, if your business did have leasehold improvements, you definitely want to consider one of those two options, either amending your 2018 tax return or filing the 3115 with the 2019 tax year. As I previously mentioned, you really want to look at this holistically, depending on the type of entity that you have, and then also looking at the rates, because one year will likely yield a better result than the other. The one thing I do want to point out, because this presentation is limited to federal tax consequences and not so much at the state level, most states have decoupled from bonus. So while there may be a federal tax benefit, there will not be a state tax benefit. So just something that I want to point out. The other item is the federally declared disaster loss. So this is a pretty hot topic right now, and some of you may have heard about what's called a Code Section 165I. Historically, that has not been a code section that most of us in areas that are not around bodies of water or are in a tornado or hurricane type of environment would really have heard of before. So someone in Pennsylvania will likely have never seen this or heard of it. Basically, the provision exists for casualty losses, and if the jurisdiction has been declared by the president a federally declared disaster area, Code Section 165I kicks in, and the benefit is that you can elect, it is not mandatory, it is an election that you make with the filing of your tax return, to take a loss that was created in a subsequent tax year and bring it back to the prior tax year. So in our case, we have, are living through COVID. The president declared the entire country as a federally declared disaster area back in March. And now any losses related to COVID have the potential of being brought back from 2020 into tax year 2019. For this organization and its members and many of my clients who are in the manufacturing and distribution space and in the food distribution space, this is a very big provision because it particularly applies to businesses with inventory. And many clients and business owners had a lot of inventory that was spoiled or went bad or was unsellable. And this provision basically allows us to quantify the loss that actually happened in 2020 and elect to bring the loss back into 2019. What's the benefit of doing that? Well, the benefit is that it's going to drive what was otherwise a pretty normal tax year operationally. It would drive the tax liability down. And again, given that July 15th is our due date right now for extensions or filing, there may be some real opportunity to accelerate deductions from a 2020 tax year back into 2019. Again, businesses with inventory, this is definitely something that you want to look at if you have inventory or spoilage or anything along those lines. The other benefit to bringing it back to 19 instead of 20 is that if you're a pass-through entity, you have excess business losses that are allowed in excess of that 250 or 500. Now, while that benefit is also available in 2020, from a cash flow perspective, there may be more benefit to bringing it back to 19 to reduce taxable income in 19. If the loss generates an NOL, whether it's at the corporate level or at the individual level, then we go back to all those NOL provisions that we previously discussed, where you now have a 5-year carryback claim ability. And if you were to maintain that in the 2020 tax year, you'd in essence be foregoing 1 year out of your 5-year carryback claim. Because right now in 2019, you can carry that back 5 years or to 2014. If you were to leave that loss in 2020, you can only carry that back into 2015. So there's a lot of opportunity here to speak with your advisors, financial advisors, CPAs, CFO, to see if there's a real opportunity here to save some cash flow, save some taxes, whether it's at the corporate level or at the individual level. Lastly, I did want to mention, again, as I stated earlier, the PPP loan has been increased to 24 weeks for purposes of forgiveness, as well as the payroll allocation decreased from 75% down to 60%. So as most of you know, if you've been working through the PPP application process, your expenses in order to be forgiven really have to fall into a few categories: payroll, retirement contributions, rent, or interest expense. And in this case, businesses were questioning, well, what if my allocations are a little bit out of line? I won't make the 75%, or I will have more than what I'm supposed to have towards my other expenses. So now, by increasing the length of time, it will allow more and more businesses to fall within the forgiveness computation. I mean, certainly there are still requirements with respect to what they call FTEs or full-time equivalents. And the loan amount was actually based on 2.5 times payroll cost. But the forgiveness aspect has a lot to do with FTEs or full-time equivalents. So I just wanted to make that distinction. The other piece that I think we're still lacking, and hopefully we will get clarity from the SBA in the coming weeks as they continue to issue more guidance and increase the FAQs that they've released. The one area that is lacking with guidance is M&A and M&A considerations. So some of our clients have been going through transactional items where they've either sold portions of their businesses or acquired new businesses. And given the way that the PPP forgiveness is structured with the FTEs, many questions have come up with respect to, well, if I sell a portion of my business and my FTEs get reduced, am I now going to be penalized from a forgiveness standpoint? And that has caused a lot of discussion in the industry. Again, we are hopeful that there will be some release of additional guidance from an M&A perspective if someone were to sell a business that previously had a PPP loan or a portion of their business, or conversely acquired a business with an existing PPP loan. One other thing that I thought was very relevant for this group is donation of food inventory. So the old law says that the deductible amount is limited to your basis, which is basically what you paid for the food or the materials or inventory, however you quantify it, plus half the gain that would have been realized on the sale of food. For C corporations, it can't exceed 15% of the corporation's taxable income. For taxpayers other than C corporations, it can't exceed 15% of the aggregate income for which all the taxpayer has for all of its trade or businesses that had contributions. So this really means that if I'm a taxpayer that have 3 lines of businesses or 3 separate businesses, each one of them made taxable contributions, one had a loss, one had income, I'm really aggregating all of that activity, and then I'm taking 15% of that, and it can't exceed that amount. So the new limit increases that from 15% to 25%. So why is this important? Again, we've seen, I think on the news and just in various discussions with people, we have a lot of people that are struggling in the world, and there's been an awful lot of food donations going on. Businesses that have excess inventory where otherwise the inventory would get spoiled if it wasn't donated to an organization. This is a great way for businesses to give back to communities, to get an additional deduction on their tax return, and really avoid some of the spoilage that tends to happen with food and beverage businesses. So I did want to mention that as well. So last but not least, I do want to touch on some planning opportunities with respect to succession planning. And I think currently, we are in a difficult time, and I think businesses are really trying to figure out the best way to proceed, stay afloat, make sure that they're pivoting as the regulations keep changing in the food and beverage space with seating and food service, et cetera. But this might be a really good time if your business is family owned. Consider some of the succession planning that you may have been putting off in the past. Now, I will preface this that transitioning a business from one generation to the next is not just a tax play. And it's not just about, is this going to be the best time from a tax perspective? There's clearly family considerations. There has to be a plan in place over time. There has to be a conversation with roles and responsibilities on the transition, what the founder or second generation owner is their vision and how long they intend to stay in control and steer the ship versus the next generation that they want to transition to and what their roles and responsibilities are. But why this is a good time from a tax perspective is really twofold. So number one, given our current state of the economy and the world, and just in general, particularly in the food and beverage space, the value of the business in 2020, actually now in June of 2020, may actually likely come in at a far lower amount that it would previously had been appraised at in 19, or hopefully different than what it would be appraised in 2021. So that's always, the first consideration, a lower valuation. Why is that important? As I mentioned at the onset of this discussion, we are at a point where we have double the unified credit amount. That unified credit can be not just utilized for estate tax purposes, but can also be utilized for gift tax purposes. So we have approximately $11.5 million to work with. So having said that, we also know that that provision will sunset in 2025, and it will revert back to the $5 million. So let's just do a hypothetical. If you go out and value your business, and you thought last year the value of the business was $15 million. Post-COVID, the value of the business has shrunk, and the value of the business now is $10 million. And certainly we want to get it back to the valuation of $15 million. But what is the tax consideration there? You may want to think about moving some or all of the ownership, if that was the long-term plan anyway, to the next generation. And why would that be important today? Well, let's say the founder wants to move 50% of the ownership from himself or herself to the next generation. So you have a $9 million valuation. 50% of that would be $4.5 million. That $4.5 million, if you were to gift that ownership to the next generation, you would still be well within the unified credit limit of $11 million. Let's say you wanted to gift 100%, then $9 million of the value would be excludable from gift tax because the exemption amount is $11.5 million for married filing joint. So now this is really looking at succession planning in a vacuum. Clearly, you want to have a conversation with your estate planning attorney. Clearly, if you've used some of the unified credit in the past, that will come into play. You also need to be aware that while the IRS has come out and said that they will not claw back for any gifts that were made during this time. So let's say you utilize your full unified credit of $11.5 million, and then it drops to $5 in 2026. The IRS won't come back and say, oh, you had a taxable gift. However, you will have used up your entire unified credit amount. And that's the tax landscape as we know today. We don't know what's going to happen next year. This year, we've had so many legislative changes in the last couple of years, much more so that, frankly, when I started out in public accounting, that I think this is really going to be the landscape of the future. We will continue to see tax legislative changes, mostly not annually, but likely every few years. And certainly when many of these provisions sunset, we will likely see some additional legislation at that time. So I do want to bring this up. This may be a good time to think about those types of issues. But again, I highly encourage the participants to really talk to their estate attorneys, their regular attorneys, their accountants, to see from a timing standpoint if this is a good time to embark down this journey. So with that, I think I'm actually great on time. I did leave enough time for questions. So if there are any, I'm happy to take them, and I will also stop sharing my screen. So I do not see anything in the Q&A or the chat section, but I don't know if anybody wants to be brave enough to ask.
Thanks a lot, Olga, for your presentation.
Sure thing.
It was great.
Yeah, sometimes it's challenging to present tax in an interesting way. So hopefully nobody fell asleep.